Most people dream of earning $500, $2,000, or even $5,000 per month in dividend income. But how much money do you actually need invested to make that happen? Today, you'll get real numbers, real math, and a clear blueprint you can start using right now. Understanding the dividend math. Dividend income is predictable, but only if you understand the core formula. Your monthly income depends on two factors: how much you invest and the yield of the assets you choose. In simple terms, the higher the yield, the fewer dollars you need invested. But higher yields usually carry higher risk, which makes choosing the right range important. Most investors stick with a yield between 3 and 6%, a level that balances income and long-term safety. This gives you a framework. At a 4% yield, every $100,000 invested produces about $4,000 per year in income, or roughly $333 per month. At a 6% yield, that same $100,000 brings in about $500 per month. These numbers allow you to plug in your income goals and work backward. Action steps are simple. First, decide on a realistic yield target. For beginners, aim for 3 to 5% using diversified index funds or broad dividend ETFs. Second, calculate your monthly income target and divide it by your target yield. Third, confirm whether your goal is realistic based on your savings rate and timeline. How much you need for $500 per month. Let's calculate the first target: $500 a month in dividends, or $6,000 per year. If you invest in a 3% yield fund, you would need around $200,000 invested. At a 4% yield, the number drops to $150,000. At a 6% yield, you only need about $100,000. This range is where most investors decide how aggressively they want to structure their portfolio. For many households, $500 per month is a meaningful level. It can cover groceries, insurance premiums, or utilities. Achieving it requires planning, but it's far from impossible, especially over a long investing timeline. If you invest $500 a month at a 7% return, you reach $100,000 in about 12 years. Double the contribution to $1,000 a month, and you can get there in around 6 years. Action steps. Set automatic contributions to your investment account. Prioritize tax-advantaged accounts like IRAs or 401ks where dividends can grow tax-deferred. Pick 1 or 2 diversified dividend ETFs and contribute consistently. Steady contributions matter more than perfect timing. How much you need for $2,000 per month. Now let's look at a far more ambitious goal: $2,000 a month or $24,000 per year. At a 3% yield, this requires $800,000 invested. At a 4% yield, you need $600,000. At a 6% yield, the figure is $400,000. Many investors don't realize how achievable this is over a long timeline. Even starting from zero, investing $1,500 a month at a 7% return can build $400,000 in about 14 years. Reaching this level dramatically changes your financial freedom. It may not fully replace a salary, but it can reduce work hours, fund travel, or give you stronger stability during uncertain periods. The key is an aggressive but realistic long-term investment plan built on diversification and discipline. Action steps. Increase your savings rate by 10 to 20%. Combine broad market ETFs with dividend-focused funds. Reinvest all dividends during your accumulation years. Review your portfolio annually to confirm your target yield remains realistic. For many people, $5,000 a month in dividends is the ultimate milestone. That's $60,000 a year, which is enough to retire in many states. To reach this goal, you need significant capital. At a 3% yield, you need $2,000 invested. At a 4% yield, the target is $500,000. At a 6% yield, the number falls to $1,000. This is where long-term compound growth shines. If you invest $2,000 a month at 7%, you reach $1,000 in about 22 years. Increase contributions to $3,000 per month, and you hit that goal in around 17 years. Consistency and discipline matter most. Many people underestimate what's possible when investing becomes automatic and long-term. Action steps. Raise income through career development or side work so you can increase investment contributions. Avoid lifestyle inflation. Use tax-advantaged accounts first, then taxable brokerage accounts. Keep your portfolio balanced between income growth and stability. Choosing the right dividend yield target is critical. Some stocks offer yields above 8 or 10%, but these are often unstable and riskier. It's better to build around stable, moderate yields that come from strong businesses. This is why ETFs focused on dividend growth or broad market index funds remain the safest foundation for passive income. Actionable steps include checking the dividend history of your chosen funds, looking at the payout ratio, and diversifying across multiple sectors. Don't rely on a single stock for most of your income. Instead, spread your investments to limit risk. Your goal isn't just high income today, but stable income for decades. Many beginners chase the highest yields, but dividend growth strategies often outperform over decades. Companies that raise their dividends consistently typically have stronger financials and more predictable earnings. As they increase payouts, your yield on cost grows without needing additional investment. Action steps. Consider combining high-yield assets with dividend growth ETFs. Allocate 70% towards stable dividend growers and 30% toward higher yield options. Review dividend growth rates annually. Reinvest dividends to accelerate compounding. Dividend taxes vary by state and income level. Failing to consider them can distort your true income. Tax-advantaged accounts help reduce or defer taxes, significantly increasing long-term gains. Roth accounts offer tax-free growth, making them ideal for dividend investing. Actionable steps include using Roth IRAs when possible, maxing your employer-sponsored plans, and learning the difference between qualified and ordinary dividends. If you invest in a taxable brokerage, consider holding funds with lower turnover to reduce tax exposure. Dividend income is not just for wealthy investors. You can start with small amounts and grow over time. The key is building a system that is consistent and automated. Begin with low-cost index funds or beginner-friendly dividend ETFs. Add contributions monthly. Track your yield and reinvest dividends for compounding. Action steps. Open a brokerage account with automatic monthly deposits. Create a simple 3-fund plan combining a market index, a dividend ETF, and a bond or REIT allocation. Set annual goals for how much new capital you want to add. Use free calculators to project income. The path to each target: $500, $2,000, $5,000. To earn $500 per month, aim for a portfolio between $100,000 and $200,000 depending on your yield target. To reach $2,000 per month, aim for $400,000 to $800,000. For $5,000 per month, expect to need $1,000 to $2,000. The sooner you start, the easier it becomes through compounding. Action steps. Increase investments by at least 1% every quarter. Use bonus income or tax refunds to accelerate contributions. Review your progress every 6 months and adjust contributions if needed. Stay consistent even during market downturns. Your long-term plan should combine diversification, stable yields, growth, and tax efficiency. Focus on ETFs with proven track records. Reinvest dividends until your portfolio generates income that covers a portion of your living expenses. Avoid panic selling. Follow a disciplined investment routine that spans decades. Actionable steps. Document your dividend strategy, review it annually, and make adjustments based on your life goals. Automate everything you can. Keep your expenses low so you can save more. Treat dividend investing as a lifetime habit rather than a short-term tactic.